Tech surged nearly 2% to carry the market higher, as the QQQ's massive outperformance proves that high-margin growth is the only engine left. Despite a fear index reading of 38 and escalating policy risks, the semiconductor sector just staged a 5.7% structural breakout. The fact that the equipment-heavy SOXX outperformed the concentrated SMH signals a pivot from AI speculation to a massive, hardware-driven front-running of domestic supply chain insulation. This isn't a relief rally. It's a fundamental re-rating of the SOXX as hardware becomes the ultimate policy hedge. The Denver Stock Lab issues a hold rating for the VanEck Semiconductor ETF with a score of 58 out of 100. While the fund's 4,068% return this year is historic, the heavy 20% concentration in NVIDIA creates a single point of failure within the portfolio's architecture. This extreme weighting suggests the fund is no longer a diversified sector play, but a leveraged bet on one firm's supply chain. Our data teardown reveals the structural vulnerability. SMH surged 4.9% today to $566.54. This move is not just market sentiment. It is the physical reality of massive data center capex hitting the order books of 3 specific companies. The lab views SMH as SMH is not a semiconductor fund. It is an NVIDIA delivery vehicle with an Intel-shaped anchor. The marketing promises diversified exposure, but the engineering reality tells a different story. The top 5 holdings represent nearly 50% of the entire net asset value. This concentration creates a massive structural bottleneck for your capital. When the broader sector rallies, SMH often stalls because of its rigid weighting. Over the last month, SMH lagged the equal-weighted XSD by nearly 20 percentage points. We see a fundamental design flaw in the 7% weighting allocated to Intel. At the lab, we track the foundry shift with precision. Intel's manufacturing struggles act as a dead weight on the fund's overall performance. Meanwhile, TSMC sits at just 10% despite powering the entire global AI ecosystem. You are paying 35 basis points for a fund that lacks the agility of its competitors. The staggering year-to-date return of over 4,000% is a statistical outlier driven by hyperconcentration in one name. It does not reflect a healthy or broad-based industry expansion. The 3-year average of 63% is the more honest metric. It reveals the heavy cost of carrying legacy components in a high-speed market. The fund DNA is built for a 2015 hardware cycle, not the current AI infrastructure race. SMH is a concentrated bet on legacy hardware giants masquerading as a diversified technology index. Investors are currently paying a staggering 4.9% markup just to own the underlying silicon in this basket. This massive premium to NAV reveals a structural bottleneck within the VanEck Semiconductor ETF. While mainstream media fixates on trade war rhetoric and Greenland headlines, the tape tells a different story. The 5-day volume ratio of 1.19x confirms that institutional capital is aggressively positioning for a breakout. This is a massive net inflow. We are witnessing a total decoupling of market price from the actual net asset value. The RSI currently sits at a blistering 82.4. This puts SMH in extreme overbought territory. The fund is trading nearly $150 above its 50-day moving average of $434. SMH has delivered an explosive 4,068% return this year, yet its internal architecture is currently redlining. We see an RSI of 82.4, signaling the fund is dangerously overbought. Wall Street markets this as diversified exposure. The lab sees a concentrated hardware bet. NVIDIA and Taiwan Semiconductor represent nearly 29% of the total net asset value. This is not a broad sector fund. It is a high-stakes wager on the world's most fragile supply chain. Current U.S. tariff policies are not just macro noise. They are direct margin killers for the top holdings. When import costs for critical components rise, these firms face immediate margin compression. The AI ETF score of 58 reflects this structural tension. While the MACD shows a bullish crossover, momentum is hitting a ceiling at the 594.87 resistance level. We are tracking the 538.21 support floor with precision. If that level breaks, The current fear index of 38 suggests a rapid institutional exit. The structural reality is that SMH is a car with a massive engine and no brakes. We do not chase overextended hardware at these technical extremes. The lab's verdict is to wait for a cooling period. Do not add to SMH positions until the RSI drops below 70 or price action clears the 594.87 resistance on heavy volume. We are holding current positions but refuse to buy the top of a supply chain bottleneck. SMH is currently a high-performance machine running too hot for new capital. iShares Semiconductor ETF earns a 58 to 100 lab score, placing it firmly in hold territory. The fund is currently screaming into a technical wall with an RSI of 77, signaling it is. SOXX just surged 5.67% to $520, but the headline gains mask a structural fracture. While the media chases the 5,000% year-to-date anomaly, the lab is looking at the RSI hitting 77.8. This indicates extreme overbought territory where momentum is decoupling from hardware reality. We are seeing a massive squeeze in Broadcom and AMD, which both sit at 8% of the total fund weight. Broadcom is driving this move because their custom silicon for AI clusters is hitting peak production cycles right now. AMD is the secondary engine as they aggressively capture market share from legacy data center providers. Micron rounds out the top three at 7.6%, benefiting from a structural shortage in high-bandwidth memory. The marketing narrative claims SOXX offers broad semiconductor exposure, but 24% of your capital is concentrated in just these three tickers. This isn't a diversified sector play. It is a concentrated bet on high-end AI networking and memory architecture. We are also tracking heightened geopolitical risk as Iran labels U.S. movements a reckless military adventure. This rhetoric threatens the stability of energy prices required for power-hungry fabrication plants. When the RSI crosses 75 alongside such heavy top weighting, the risk of a sharp mean reversion outweighs the momentum. The structural drag of an overextended RSI will force a short-term pullback regardless of the bullish moving average alignment. SOXX is currently a liquidity trap for late-cycle retail buyers. SOXX is currently holding a massive anchor that mainstream analysts refuse to acknowledge. While the fund boasts a staggering year-to-date return of 5,340%, its internal architecture is fundamentally flawed. We look at the top 5 holdings and see a dangerous misalignment with the actual hardware cycle. AMD and Broadcom sit at the top with 8% each. However, Intel remains a top 5 component at 6.3% of the total net asset value. At the lab, we view this as a structural failure. Intel is a legacy fab play struggling with node transitions. It does not belong in a high-growth engine next to NVIDIA. This 36.8% concentration in the top 5 holdings is marketed as diversified exposure. In reality, it is a concentrated bet on yesterday's leaders. Look at the 1-month performance against its peers. SOXX trailed the equal-weighted XSD by a massive 14.8 percentage points. This gap proves that the fund's cap-weighted design is missing the mid-cap specialty silicon rally. Fund managers are selling you a broad semiconductor narrative while charging an expense ratio for a diluted product. You are paying for exposure to manufacturing laggards that dilute the gains of the AI frontier. The 3-year average return of 53.8% is respectable but deceptive. It masks the fact that this fund is too heavy on legacy silicon to capture the next hardware shift. SOXX is an inefficient legacy vehicle that forces investors to carry Intel's baggage to get NVIDIA's growth. SOXX is trading at a massive 5.6% premium to its net asset value. This disconnect signals that institutional demand is currently outstripping the available supply of the underlying shares. While headlines scream about trade wars and tariff uncertainty, the 5-day volume ratio is 1.19 times the 20-day average. Capital is flowing in, not out. The lab reads this as a forced entry by major funds into the semiconductor stack. An RSI of 77.8 suggests the fund is technically overextended. Yet, The bullish MACD crossover confirms that momentum is overriding traditional technical resistance levels. Wall Street PR focuses on the technology labeled to mask the concentrated hardware risk within the top holdings. They want you to fear geopolitical noise like China's internal military purges. We look at the massive year-to-date return as evidence of a structural re-rating of silicon as a sovereign asset. The gap between the market price and the NAV proves retail is paying a heavy tax for late entry. Meanwhile, institutions are using this liquidity to position for the next hardware cycle. We do not see a standard pullback. We see a structural shift in how the market values global compute. The premium is the price of admission for this specific momentum. Every dip toward the $446 moving average is being aggressively bought by automated flow. SOXX is no longer a proxy for tech. It is a leveraged bet on global compute dominance. We are buyers of this strength. SOXX is currently screaming into a technical wall with an RSI of 77.8. While the mainstream narrative focuses on its massive year-to-date outperformance, the underlying structural integrity is fracturing. We see a significant disconnect between the marketing of diversified exposure and the reality of its 16% concentration in just two names, AMD and Broadcom. These are hardware giants currently caught in a vice between surging AI demand and escalating tariff costs on Chinese imports. Wall Street calls this a balanced play. The lab calls it a concentrated bet on high-margin silicon that is becoming increasingly expensive to manufacture. When tariffs hit, they do not just affect the top line. They erode the gross margins of the companies representing nearly 1/5 of this fund's total value. The technicals confirm this exhaustion. Despite a bullish MACD crossover, the extreme RSI suggests the current rally is overextended. Institutional capital is showing hesitation as the Fear and Greed Index sits at 38. We are tracking the 5G smartphone cycle as a potential catalyst, but it cannot offset the structural drag of global supply chain friction. Our AI ETF score of 58 out of 100 reflects this fundamental mediocrity. This is not a core holding for the next quarter. It is a tactical vehicle nearing its limit. We expect a retracement to the support level of $494.28 before any meaningful entry point emerges. Do not chase this move into the $546 resistance. Semiconductor indices are currently stalling as non-AI inventory bloat finally offsets AI-driven gains. Is the AI hype enough to overcome the massive industrial chip glut, or is the cycle peak already behind us? Please remember, this analysis is for educational purposes only and is not financial advice. Always conduct your own thorough research before investing as